please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, Ashwani Gujral is with us to discuss what he's strategizing at 11:30 a.m. today. Ashwani, over to you then. For the Nifty, we're just about hovering at 10,400. But the Bank Nifty is off the day's high, giving up gains.
Well, if the entire banking system is sitting at SFIO, that's not great for confidence. And, market will take cognizance of that. And whether there's something wrong or not, this sort of uncertainty cannot keep on lingering on. So earlier it was PSU banks. Now if these guys also start to get involved, then I think whatever little short covering rally was on the way, that is aborted. So I would think Nifty, Bank Nifty, etc., you should go short on right now. And in terms of individual stocks, I think you can easily sell Canara Bank with a stop around 282, target of 268. BoI is a sell with a stop of 112, target of 104. And Sun TV is a buy with a stop of 930, target of 965.
Levels, essentially sell the indices for what targets, Ashwani?
See, basically, with this sort of action where you hardly couldn't gain even 100 points on the Nifty, 10,300 is the first port of call. And on the Bank Nifty, I think it's going to break 24,800 rather decisively from here. So maybe 24,600 thereabouts. It all depends on news flow. If we keep on creating this uncertainty, I don't think bears are even going to cover their shorts.
Just a quick word on metals once again, Ashwani.
Well, metals, that was the first space which gave you that hint that although there was positive news, but even metals was facing selling. So that just probably is the general market, which is not feeling so good and selling into all kinds of good news also. I would think they would break their recent lows and go lower, because if they can't rally on this sort of news, then chances are that the market is fairly weak and is seeking lower levels, whatever the news flow might be.
We got some strength in oil marketing companies. Likely to last or no?
This OMC, etc., they won't fall too much, but will you make great amounts of money by buying them? That does not look like the case till, crude gets to 55 or something.
Okay, well, let's get in a couple of Twitter queries, Ashwani. First is Viveka, 10,000 shares of Bhushan Steel at 51, wants to know whether he should add more or not. Whether she should or he should.
This is not a small investor play. So I don't think he'll make too much money, because generally, what I understand, equity holders should not get anything. So move on to mid-cap IT. Whenever the market recovers, chances are that will go up.
Okay, one more. Shiraz has 1,000 shares of Sun Pharma at 550, wants to know the way forward.
Sun Pharma, you know it better than me. Every day one news is good, another news is bad. If you have to be with pharma, maybe Biocon is a good story. But overall, I don't like the sector too much, because there isn't ever any sort of blue skies. So 1 week it's up, 1 week it's down. Maybe, yeah, they have bottomed out. But if we keep getting these, periodic negative news flows, it's very difficult to construct a rally.
Okay, Ashwani, thanks very much for that. Appreciate it. The Bank Nifty is come down into the red. So 24,788 is where the index is at right now. It's the day's low. It's also down about 36 points or so. The high today on Bank Nifty was what, 25,040. So we're quite a distance off from those levels. I think are also going to take stock of the sectoral indices very quickly once before we go any further. The Nifty, by the way, is selling off a little bit more. We're up just 26 points now, which means from the last we took the commercial break, we're down about what, 12 or 15 odd points or so. So the PSU Bank index is down about 1%. You've got the pharmaceutical index, which is down about 0.25%. And you've got the auto index, which is absolutely flat, but still down in the red. Anything else, Ekta, you're picking up?
Well, no, not right now. So I think we have Nigel who's waiting by to give us an update with regards to ACC Ambuja. We understand that there is some concern which is arising on the technical know-how fee. So I'm just going to go over to him and he's going to fill us in on the context and what this means. Nigel.
Actually, it's good news coming in there for ACC as well as Ambuja. I'll tell you why. Because a couple of brokerages have written overnight. CLSA, they are talking about the technical know-how, Ekta, that you were talking about. In fact, remember in 2013 itself, Lafarge Holcim, they had levied a 1% technical know-how. Now, it was a big deal at that point of time. Importantly, that was for a period of 5 years. Now, those 5 years expired on December 31st, 2017. And we haven't heard from them with regard to that. So whether or not it's renewed, whether or not it's hiked or not, for the time being, it appears as a bit of a relief because we haven't heard from them. And remember, in terms of a sensitivity analysis, 1% technical know-how price that they would be paying as a percentage to the parent, that would impact the EPS estimates by nearly around 5%. So if that's levied, then it will not be good news. But till now, we're 2 months already into the calendar year. We haven't heard about that. So that could come as good news. Deutsche Bank, they have written about Lafarge Holcim's 2022 strategy. And they're quite impressed today. A couple of reasons. One is that they're talking about growth now. They're talking about growing in markets that, in fact, provide that kind of an opportunity. And secondly, they're talking about empowering the management in that particular, that particular country. For example, the Indian operations will be handled by all those on the top in the Indian operations. So that's going to be good news. They're saying that, in fact, in the past, the management has been talking about increasing the revenues, increasing operating profit, as well as the net profit. Now, this time around, they're talking about market share. Remember, in the last 5 years, ACC as well as Ambuja, they have lost a good deal in terms of market share. And in fact, in the last 10 years, it's nearly around a 700 basis points correction that we have seen in terms of the cement sales. On the back of that, Deutsche Bank is quite impressed. Remember, they have been positive on ACC. They have a hold rating on Ambuja Cements. They prefer ACC over Ambuja Cements. Why? Because on valuation parameters, they believe there's better scope. And in fact, ACC gives a better reward in comparison to Ambuja Cements. Back to you.
Okay. All right, Nigel. Thanks very much for that. Just want to throw some light in terms of the constituents of the Bank Nifty because, like we mentioned, it's actually slipped into the red. And the key culprit seems to be what's happening with ICICI Bank. That stock is now down around 1.2%. To put it into perspective, when we started the show, the stock was actually in the green. We had the news about the SFIO summoning Chanda Kochhar of ICICI Bank, and you're seeing now that kind of reaction probably coming into that, or maybe just normal profit booking onto that particular stock. So ICICI Bank, which is at the low point of the day.
The market is up 28 odd points or so. There's news at the bottom of the screen. Axis Bank has increased some bulk deposit rates by between 10 and 50 basis points. Usually bulk deposits only form a very small proportion of the deposit base of most banks. So this won't really matter that much for Axis. 526 or so is what Axis is trading at this point. 30 points higher on the Nifty. Ashish Somaya is Managing Director and CEO at Motilal Oswal AMC. He's joining us right now. Ashish, good morning. Great to have you here. Is the flow of, are the inflows still as strong as they'd been? I mean, in January, December, months before that? I'm talking about Feb.
So December obviously was a record, and January number has to be seen a bit in detail because we showed January as 16,000 crores net flow as far as equity mutual funds are concerned. But the unique thing about January, before I come to Feb, the unique thing about January was that the gross inflow, because this number consists of inflows as well as redemptions, and that's how we arrive at the net number. So January was pretty high, more than 50,000 crore of gross inflow, but I think the uncertainty related to tax resulted in some redemptions because people started hearing about the implementation of long-term capital gains tax, but there was uncertainty on how it would get implemented. So between 15th January to 31st January, the industry saw kind of redemptions, and despite excellent inflows, it's the redemptions which played spoil sport, and January ended at about 16,000 crores. Now obviously as far as February is concerned, my estimate is around 18 to 20,000 crore net flow. We don't have the numbers yet, but it was maybe as good as what January was. February was not as high because December was 28,000 crore net flow, which was more like a record. So what we are seeing is that the inflows continue to be as strong as they were. January it was the redemptions which played spoiled sport. February the data is not yet out, but my sense is we will be better than January.
Okay. So Ashish, just going into the next fiscal, what is your sense in terms of the kind of flow picture we're working with? Because there will be technicalities such as CLT, CG, which will be out of the way. So in that sense, redemptions as well as flows?
So, I think that redemption bit was one-off in January. That's why I kind of went into details of explaining what caused the blip in January. My whole intention was to point out that it was a one-off. Maybe December 28,000 crore net flow was also an outlier because our annual average is right now more between 22,000 crore kind of number. So I don't expect a significant let-up, or I don't see anything on the horizon which will cause people to hold back significantly. In fact, usually what we see is that when there is a correction which kind of prevails, I mean this was too short and sharp. Suddenly we just saw in the first 3-4 days of February we saw a significant decline, and then the market has kind of stabilized in a particular range. Typically when there are sharp corrections, the first reaction we see is for people to put in a lot of money, because even as we speak there is money on the sidelines and people have made good returns in the last couple of years. Plus at the same time, it's not like other alternative asset classes are really looking too great. It's not like there has been a huge bump up as far as interest rates or fixed income funds are concerned. It's not even like there is huge money which is going into, say, real estate or gold. So I don't see anything which would create a kind of let up as far as flows are concerned. So our picture remains buoyant like it has been so far.
Mm-hmm. But you would agree, Ashish, this is the first, I mean, I hate to use the word sustained, but it's kind of this you said sharp and swift, but it's not as if it's seeing a big V-shaped recovery as well, right? I mean, it's lingering, festering. That sometimes is more of a problem than a sharp, swift cut and then a sharp recovery.
So what, as a fund management company, honestly, I am not really complaining about this particular decline, because let me put another perspective, that last year was very difficult for most of us. Because if you see 2017, it was no fun, because the index itself, if you see mid-cap free float, the mid-cap 100 index, the whole index went up 40%. And when the whole index goes up 40% with everything which is deep value, contrarian, cyclical, just flying through the roof, then as a manager you don't end up looking really smart. So once in a while corrections are good. It's not like it's impacting the performance in a very bad way. In fact, if I speak about us, it's only helping us to pull back some alpha when the market is a bit more discerning in terms of what's working and what's not working. So I'm not very worried if there is kind of festering as far as the index is concerned, doesn't do too well. At least I think as long as marketing is discerning, we will be able to make some money.
In terms of sectors, what is your opinion right now? What are you liking and what are you not liking?
See, we are, if you really ask me, from our perspective, the budget was in line with what we really thought, what you would expect of a typical, last budget before the election. And unfortunately, so many things happened after 1st February that there was no discussion on what the budget can, result in. So we were always batting for, this kind of huge money to be spent as far as, trying to win an election is concerned. So, this whole spray and pray approach which has been played out. So there's money being sprayed in multiple sectors, and which I think is all related to rural growth and consumption. So a lot of our investments, a good part of our portfolios are in this discretionary and staple kind of play. The second obviously is in auto, and if you see the sales numbers and the traction, whether it is commercial vehicles or whether it is passenger vehicles, you're already seeing it. The other sectors which we've always been gung-ho as far as overweight as far as private sector banks, NBFCs and insurance companies are concerned. So that's been largely the lay of the land. We were never so exposed to either public sector banks or to the deep cyclicals or to the metals in a very big way. So not much change as far as our portfolio strategy is concerned. Only thing obviously we are seeing is that there is a bit of rotation in the market, and that's working in favor.
Right. Ashish, this, the SEBI rules which were proposed, right, in terms of categorization of mutual funds, etc., that has got a hard stop. I mean, it has to be done before the 31st of March?
No, so actually it's a one-on-one kind of process. I mean, every asset manager, obviously the lay of the land is clear, the rules are well defined. Now what you need to do as an asset manager is you need to go back to the drawing board and review all your schemes and portfolios, and you need to go back to the regulator with a set of proposals telling them that, you know, how does the regulation impact and what are the changes you propose to make in each of your portfolios. Are you going to merge some schemes? Are you going to change the investment universe for some of the schemes? So all of us have to go back with a set of proposals, and to the best of my understanding, each and every AMC is right now involved in a kind of dialogue with the regulator. Of course, it's not like an open-ended process. I mean, there is a particular timeline, and yes, you're right. I expect that before the year ends, everybody is expected to get approvals from the regulator for their individual set of proposals. So if I speak for myself, for example, this is public information. If I speak for myself, our approvals have already are in place, and we have put certain addendums in the newspapers and in the media which talk about what changes we are making. So similarly, for all fund houses, we have to wait for them to come out with the changes that they are making, and I expect that before this year ends, everybody would have got their approvals. And
do you expect, now that there's clarity, etc., big changes at an industry level? Yeah, so clearly what I'm saying is not something very, very new, but two changes I expect. I mean, see, one is that if you see the large cap space, so if your fund is in the large cap category, then that clearly gets pretty much straitjacketed, because the regulation says that you need more than 80% of your portfolio in stock number 1 to 100 by market cap. So that makes a large cap fund pretty disciplined and straightforward, and plus, you know, with total return benchmarking, I believe that it is going to make things a bit difficult as far as pure large cap funds are concerned. But if you see the rest of the space, for example, mid caps, I mean, there have been reports out there which say that mid cap funds are generally underinvested because they need to be 65% between 101 to 250, and funds are generally underinvested in that space because they've kind of sprayed the investment across, because previously there was no such definition. So I do agree with that kind of report, because I have myself seen that in certain spaces the funds are underinvested. It's a reality if you see the data. And once their approvals comes in place, then they have to put a notice of 30 days, and then after that they can start making changes to their investment universe. So it's not even that, you know, just because the regulator has made an announcement, you start making changes in your fund. There is a process of approval. So I do expect that over the next 2-3 months, at least these segment of funds will have to realign. So large cap and mid cap is what is impacted. Other than that, you know, where there are multi-cap funds, and, you know, the industry doesn't have too much by way of small cap, and multi-cap funds or other segments of funds are not impacted at all. It's the large cap and the mid cap that's the space one needs to watch out for.
Yeah, Ashish, we're going to let you go on that note. Thanks very much for joining in and speaking with us.
So 30 points on the Nifty, 10,388 is where we are at. The big talking point over the last couple of days, of course, has been the much feared trade wars after Mr. Donald Trump last week essentially talked about imposing tariffs on steel and aluminum. Mary Deron is Managing Director of Sovereign Risk Group for APAC at Moody's Investor Service, and she's now joining us to talk about this from a big picture perspective. Mary, thanks very much. Appreciate you being with us here. You know, these fears are there. They spooked markets, stock markets and other markets, but many still, that people that we speak to generally are of the view that this is more likely to be a war of words rather than actual retaliatory action, tit for tat kind of action. Do you agree with that?
At this stage, we do not speculate on first whether the US would follow up the tariffs on aluminum and steel with other measures, or whether other governments would follow up with some retaliatory actions. But there does seem to be, from the US administration, a move towards trade averse, towards more protectionist measures. And as such, that could have an impact on global trade momentum and the recovery that is currently unfolding. So that's really what we're going to watch, both kind of follow-up actions by the US as well as potentially responses from other governments. The impact, as mentioned, on sovereign credit would come through really what would be broad-ranging measures that impede trade growth and puts up trade barriers globally, which at this stage is not our baseline.
Okay, Mary, what would a tit-for-tat kind of measure be from countries, if in case they go ahead with that, what would that do to global growth according to you?
A significant escalation of trade protectionism would have an impact on global growth. So we have seen, along with the kind of momentum on growth, on GDP growth, we have seen global trade picking up, and the two really are very closely related to each other. And certain regions in the world, certainly Asia in particular, are reliant on global trade. So if we were to see really significant broad-based and global measures that impede trade, then we would likely revise our growth forecast that currently project that global GDP growth will be around 3% this year and next year, which is as high as we've seen in some time.
And again, I mean, if there is a significant escalation of trade-related tensions, what will it do to, I mean, inflation? If you've looked at past episodes and what impact they've had.
So, I mean, directly, as far as steel and aluminum are concerned, so there will be really divergent impacts on inflation in the US and inflation in the rest of the world. So in the US, the cost of steel and aluminum would rise as production shifts towards domestic producers. However, given the weight of steel and aluminum in the overall US economy, we do not expect that really the price impact will be material. And some of that will be offset potentially by consuming sectors reducing, really suppressing the cost increase and absorbing that in their margin. Globally, on the contrary, then as US steel and aluminum demand shifts to domestic producers and is taken away from global demand, then there will be a negative impact on steel and aluminum prices. So we would see there a disinflationary, if you want, impact. Again, given the size of the US and steel imports in overall production of these sectors, we do not think that this is something that will be visible in terms of headline inflation. So overall, directly, no significant impact. We expect inflation to gradually pick up generally. Globally, as economic activity continues to strengthen, and these measures would not have any impact on that. If there were to be an escalation and more measures, including more tariffs being imposed more broadly, then we would review what the implications would be and adjust our expectations accordingly.
Okay, all right, Mary, we're going to touch base when there are more further developments, but thanks very much for joining in and talking to us. So that is Moody's